This could be one of the worst military situations we've had since maybe the Bay of Pigs. A lot of the problem has not really reached the general public and the overall economy yet. We all understand that the price of oil has increased significantly as a result of these hostilities, but that's really just the surface of the whole problem.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for Monday, April 27th through Monday, May 4th, 2026, while supplies last. First this week, 1 ounce U.S. Silver Eagles are just $5.75 over spot per ounce, the lowest premium we've seen on Eagles in a long time. MS62 $20 gold Liberties are just $99 over melt per coin. And finally, we will swap 3 nines fine or better silver bullion for pre-1965 U.S. constitutional silver. This is an excellent opportunity to trade your generic bullion for U.S. minted legal tender silver with fractional sizing for greater versatility, all while keeping the full amount of silver ounces. Some restrictions apply. Call us for details at 1-888-815-4237. That's 1-888-81-LIBERTY. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend, Dr. Mark Thornton from the Mises Institute. Dr. Thornton, thank you so much for joining us today.
Elijah, it's great to be with you.
Well, it's great to have you back on. I did want to discuss geopolitically what is happening right now and how it's putting really a stress on oil, also on other commodities as well. You've talked about how there are some aspects of this war and the Strait of Hormuz that we're really not looking into right now, and how it really can put stress on factors that not a lot of people recognize. Can you tell us a bit about this?
Sure. But in general, I think that, when you combine this with President Trump's failed tariff policies, undermining the American public, and now his misadventure in the Persian Gulf, this could be one of the worst military situations we've had since maybe the Bay of Pigs. And that's probably the way it's going to go down in the textbooks unless he can get this thing wrapped up pretty quickly. But it leads to a lot of complicated economics and economic analysis. It's obvious that, we all understand that the price of oil has increased significantly as a result of these hostilities. And of course, they're up again big today as well. But that's really just the surface of the whole problem. And a lot of the problem has not really reached the general public and the overall economy yet, because a lot of oil from the Persian Gulf was in transit for a long time, and there's a lot of oil that's in inventory around the world. And so we're just now getting to the point where very little oil production from the Persian Gulf is getting out. There's some smuggling going out from Iran. There's some things that are getting through the blockade. There's a pipeline coming out of Oman, and there's a pipeline coming out of Saudi Arabia. But that represents a small percentage of the overall production. But it gets even more complicated than that, because, we don't just turn oil into gasoline. Crude oil is just that. And it comes very often with natural gas or sour gas. And of course, the sour gas was just burned off a long time ago as a pollutant and as something that got in the way. And most of oil was also the same way. And it's only profit-seeking entrepreneurs that have since 1850, come up with a lot of different ways of using crude oil and all of its components, which we used to just throw away. And so these are called byproducts. And, we're learning slowly over time that these byproducts are really very important. That's where we get all plastics, for example. So it's not just, the gasoline that drives the truck that moves goods and services around. It's also what makes the tires. It's what makes the asphalt of the road. And then, everything in our bathrooms, everything in our kitchens, everything having to do with our hobbies, food production. Fertilizer comes from natural gas and petroleum. And of course, fertilizer is vital to the production of food. And so there is this delay of the effects, but the effects are very, very serious and multifaceted and long-lasting. Now, more directly, of course, and we just had the Fed meeting today. Basically, they're holding rates where they are, although there's a big dispute amongst the Fed governing body itself as to what the direction of rates should be. But with higher oil prices, that feeds directly into the consumer price index through gasoline. So if you look at the commodity index price level, 40% of that commodity index is in energy. And so with oil prices going up, that component's going to go up, driving the statistic up. Now, and that's going to make it very difficult for the Fed to cut rates. And that's what, the economy was hoping for. That's what we were anticipating getting, is several rate cuts this year. And of course, gold and silver were part of that mixture. And gold and silver, at least in the short run, react very positively to interest rate cuts, and at least in the short run, react very negatively to increases in interest rates. So the war has had a lot of effects, continues to do so, and this is something that, incidentally, if peace were to break out, it's going to be very difficult to fix this whole thing of restarting oil wells, of restarting refinery production, especially in cases where the refineries have been damaged as a result of the war. And of course, just shutting down oil wells causes a loss of production once you start them back up. So the effects are going to linger a long time. But because of this effect on monetary policy, of course, it's had a further dampening effect, at least in the short run, for the price of precious metals. And so we see a very tight correlation that when things go bad in terms of the war news, oil prices go up, precious metal prices go down. When things get conciliatory, when there's peace talks and ceasefires, oil prices go down, precious metal prices goes up. So I'm afraid that this awful situation in the Persian Gulf area has made the correction in precious metal prices that we saw break out in the month of February. It's extended that corrective phase and made it worse. And I don't see the traction really getting going until we see more resolution. And, it's hard to stop wars once you start them. And I don't expect this to be, stopped on a dime and then everything will be okay. I think it's going to be a phased approach. Hopefully it's not going to get any worse. But that's the thing to keep in mind, because I think investors, particularly new investors in precious metals, had this idea that gold was going to protect everyone all the time from any sort of calamity. Well, this is a calamity that's affecting world markets, but it's affecting a particular area of the globe that has a comparative advantage in the production of a very narrow number of goods and services, and it just has had this odd linkage. And of course, precious metals investors are trying to protect themselves against inflation, higher prices. And so when they see the price of gold not only stop from going up, but actually going down, they're naturally wondering, what the heck is going on here? But it doesn't, inflation doesn't mean, and the Austrian school economists are famous for pointing out that prices don't rise all the way across the economy up and down like an elevator, but prices move sporadically and independently depending upon other circumstances. And this is an important other circumstance. So while gold prices have been going down, the value of the dollar has been going up, the price of U.S. government bonds has been going up, commodity prices, and of course, oil prices and everything that's related to them has also been going up. So if we look at a broader measure of prices, like the consumer price index, the producer price index, or the commodity price index, they're all still going higher with increases in monetary inflation.
And you've mentioned how obviously we saw an inflationary period kind of right after COVID there for a year or two, but inflation doesn't always just happen and then subside. It often happens in waves. We saw that during the 1970s. Now, is it your view because of the tariffs, because of monetary policy, and because of this war that we might be entering soon into the second phase of high inflation?
Yes, it's monetary inflation does lead to price inflation, and there is a little bit of a lag there, but it's hard to pinpoint the prices that are going up. And it's the underlying circumstances that cause some prices to rise very fast and very significantly at a point in time where others are lagging, possibly even going down. So at certain times, the monetary inflation will stoke the stock market or the bond market or commodity markets. When things look a little out of control, of course, they tend to stoke the price of precious metals higher. If the government is inflating the money supply to pay for debt and spending that is out of control, and there's no plan to ever balance the budget or pay it back, that's when the money tends to funnel into higher precious metals prices. But it can go into all sorts of things. The price system is everything. And we're only told by the government and the media about the consumer price index. And everybody knows, your audience is very familiar with the fact that the consumer price index is a flawed construction of a narrow slice. Now, admittedly, there's a lot of important prices in there that do affect, consumer well-being, but it doesn't accurately at all either measure accurately consumer prices, and it certainly doesn't accurately measure the effect of monetary inflation, because you can have, and we have had periods where they increase the money supply, stock prices rise, bond prices rise, and consumer prices don't rise. So it's very difficult to figure out where the prices are rising. We're not really kept informed of all that, and the Austrians are really the only one. That's kind of what my own podcast, what I do there is I look for those anomalies where prices are rising extra fast or extra slow, for various reasons, and presenting an inaccurate picture of what the central bank is really up to.
For those interested in wanting to know what the central bank is really up to, you mentioned how today was the Fed meeting and we saw just them holding interest rates steady. It seems like if you look at what President Trump has wanted, he's obviously wanted lower rates, and he's nominating Kevin Warsh as the next Fed chair. I wanted to get your perspective on that? I mean, how much do you think this change of Fed chair is going to impact monetary policy? And do you anticipate that, I guess you've talked about the Fed being trapped, right? So they can't raise and they can't increase interest rates. And it seems like there's high inflation almost inevitably in your view. So with respect to monetary policy, what should people be expecting going forward, and what impact do you think that will have?
Well, one of the best pieces of news that I've seen this week was not about the meeting, actually at all. It was the fact that the Justice Department dropped charges against Chairman Jay Powell and his billion-dollar spending on renovations to the building that the Fed headquarters is in. And I think that's a good sign that President Trump is putting away some of his political hobbies, and that he might start directing his attention to improving the economy and the circumstances of the average American as we go into the midterm elections. And another important thing he can do in that respect is to make a settlement with the Iranians. He was talking with President Putin of Russia, looking for a way to construct, I hope, a way for the United States to back out of this situation. And that would be, both of those things are excellent news. So, and of course, Kevin Warsh's nomination is going ahead, at least because of that dropping of the lawsuit. But the meeting itself was such that they didn't change rates, but there was a big debate within the Fed about whether they should be biased towards raising rates or lowering rates. And the majority are biased in favor of lowering rates. A small number, 1 or 2, are biased in favor of raising rates. And then there's another number in between that are unbiased. They may raise them or lower them. So I think that this points out the kind of confusion that the Fed is in right now, because they face this higher CPI inflation on the one hand, and their gut instinct to cut interest rates on the other. And I don't think that they feel they can cut the rates when oil prices are so high. And again, I'm not hoping that the war is over so they can cut rates. I just hope the war is over. Period. End of story. It's a huge mistake, and people die, and resources are wasted, and lives around the world are disrupted. So, but in terms of monetary policy, I think the Fed, is a typical governmental bureaucracy. When faced with real world economic decisions, they really don't have any ways of figuring it out the way entrepreneurs figure things out with the profit motive, and in terms of using resources and all of that kind of stuff. It's a typical sort of result there, but note that they are almost universally biased in favor of cutting interest rates. They have one tool, and that's cutting interest rates. Right now, one of the reasons that they can hold back is because while they haven't cut interest rates recently, they did adopt a type of quantitative easing policy in December of last year. And so they're injecting $40 billion into the credit system every month. So they are actively increasing the money supply. Our recent calculations at the Institute of the increases in the money supply indicate that the money supply is growing at above stable levels. In other words, the money supply is growing at a rate that beyond what it would be necessary to keep prices from either rising or falling in general. And it's at a rate that still exceeds the rate that's consistent with the Fed's 2% target. So everybody believes that the CPI statistics are going to look bad going forward in the coming months because of the situation with monetary policy being too hot on the one hand, and then the military adventure in the Persian Gulf causing commodity prices to rise substantially.
Now, many of our viewers are obviously interested in how this is going to impact metals prices. It's interesting to look at the big picture, right? We had you on in October when silver was breaking out of above $50 per ounce for the first time ever, and now we're 40% higher than that. But a lot of people are disappointed at silver's price action. So it's interesting to kind of just take a look back and put things in perspective. But where do you think metals go from here? Because they've obviously had quite a bit of a sell-off since the beginning, I guess, really end of January, early February, since we had that peak. Do they go lower from here? Do they consolidate for a little while before making their next leg higher? Your perspective?
Well, they need direction. And right now, they do not have direction. There's been a lot of selling from the speculators, earlier in the year, and then there's been a lot of selling in the countries that are directly affected by the war in the Persian Gulf, and the precious metals market is looking for direction, and the short-term elements of that direction are typically the value of the U.S. dollar. So the value of the U.S. dollar strengthened, and so the metals are looking for it to weaken. That directly feeds into driving the price higher. Interest rates and government bonds, the short-term thing is that if interest rates fall, and that lowers the cost of speculators holding larger amounts of gold, it lowers the opportunity cost, and that drives the prices higher. So the Fed cutting rates would stimulate prices higher, type of thing, and government bonds. Is another thing. So there are short-term steering currents, but the main thing for everybody's sake, but in particular, I think precious metals, is for peace to break out and for the reconstruction of the Persian Gulf countries and their industries and their facilities to produce oil, to reopen all of those things. That would be the development that I'm looking for a clear signal. Although I don't, that doesn't mean, I think that the current price level down close to $70, I know there's technicians who expect, the correction to continue to be significant. But it just seems to me that $70 is relatively low to compared to $120, and that in the long run the price of silver is going to be much higher. So, not a market technician or a financial advisor, but just in a buy low, sell high mentality, it seems like the charts are indicating that $70 in the last, couple of months is a very low point. And the range goes up to the $90, the low 90s that have been hit a couple of times during this corrective phase. And then once we clear that level in the low 90s, then I would expect the previous trends to reemerge in these markets. The trends that, while they may have gotten overheated in January, are things that follow the fundamental factor driving precious metal prices, which is government spending, government borrowing, and government money printing. And of course, I refer to the U.S. central bank, the Federal Reserve, but these effects are pervasive across central banks around the globe. So there were expectations of interest rate cuts at most of the central banks around the world before this war broke out. And almost literally, it was reported that the anticipated expected cuts all came off the board, all in unison. And so, that's going to be the fundamental trigger. And then the technical triggers, I think, is once the price gets up to move outside of the range that it's been trading within during this correction from beginning in January 30th of this year. And I think, if I remember correctly, that the market has gone up to the low $90 an ounce level. So that's the way I sort of stage the marketplace at this point. It's been a very unusual set of circumstances, and it's blindsided a lot of investors, in particular, a lot of recent investors who got into the market after we broached the $50 an ounce level, and silver got so much attention, and when gold broached the $5,000 level, and finally the mainstream media started to pay attention in any kind of positive way whatsoever, and that drew in a lot of new first-time investors, and then initially the prices continued to go up, but of course we've since fallen into this significant correction in the marketplace, and it's really been puzzling, frustrating, and maddening for everybody in who's in this market. But that's not just something that happens in the market for precious metals. I mean, I heard similar stories, to people investing in hot stocks in the market. Like they waited for years to invest in Amazon or Apple or whatever, after it had already gone up by 4,000%, and they finally invested, and then it went down significantly, and then ultimately it went back up. And I think that's the type of scenario that we're in right now, because as far as I can tell, with the fundamental thesis is that government and money printing are continuing, and in all likelihood will only get worse going forward.
Thank you so much, Dr. Thornton, for joining us today. If our viewers are interested in learning more, we'll put a link to the playlist of the Minor Issues podcast with the Mises Institute there. Did you want to tell us a bit about what you do with the Mises Institute and how people can find you?
Yeah, we're at mises.org, and we're sort of like the world capital of Austrian economics, which is traditional, rational, free market economics. And we publish all sorts of things and have conferences and books and so forth. And our main goal is to educate students and the general public, not so much to be in favor of free markets or to be against the government, but we try to teach people why the market actually works to the benefit of everyone, and why government activity in the economy always fails and is counterproductive. So we're primarily a nonprofit educational institution, and that's our primary goal. And the Austrian school is, and under Ludwig von Mises, our namesake, was the greatest proponent of the free market. He was the main opponent of socialism and central banking. And of course, he's very famous as a hardcore advocate of the gold standard as the monetary institution from which human beings rose from very primitive animalistic creatures into the sophisticated, although still very flawed groups of individuals that we are today. And that's so the gold standard is something that's always been a very important part of the mission of the Mises Institute.
Fantastic. Well, Dr. Thornton, thank you once again for joining us today. You have a good day and God bless.
God bless, Elijah. Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for Monday, April 27th through Monday, May 4th, 2026, while supplies last. First this week, 1 ounce U.S. Silver Eagles are just $5.75 over spot per ounce, the lowest premium we've seen on Eagles in a long time. MS62 $20 gold Liberties are just $99 over melt per coin. And finally, we will swap 3 9s fine or better silver bullion for pre-1965 U.S. constitutional silver. This is an excellent opportunity to trade your generic bullion for U.S. minted legal tender silver with fractional sizing for greater versatility, all while keeping the full amount of silver ounces. Some restrictions apply. Call us for details at 1-888-815-4237. That's 1-888-81-LIBERTY. We're available after hours and on weekends, and we look forward to speaking with you.